Welcome to the Daily Insights That Matter. Now, the Employees Provident Fund Organisation is in charge of managing the Provident Fund account of employees in India, which is a retirement savings scheme where both employees and employers contribute to build a fund for the individual's retirement. Now, in order to make the most out of the money it manages, the Employee Provident Fund Organisation is considering a couple of moves. Now, the EPFO has recently begun talks with the Finance Ministry about a new investment strategy. Now, this strategy involves taking the money the EPFO receives when it sells or redeems its investments in exchange-traded funds and putting that money right back into the stock market. Now, other major change is to allow for the daily redemption of ETF units as opposed to periodic redemptions and linking the return threshold to government securities. Now, the ETF returns are currently benchmarked against the average 4-year returns of the Sensex, but they are proposing to extend this period to 5 years as well. Now, we see that India's largest pension fund is trying to implement moves that can maximize equity returns. Now, the EPFO follows investment guidelines set by the Finance Ministry, allowing it to allocate a portion of its income ranging from 5% to 15% in equity investments and related assets. Now, the suggested step of reinvesting redemption proceeds into the stock market is significant as it could potentially increase the flow of retirement funds into equities, impacting the overall investment landscape for the EPFO. Now, did you hear about the recent developments in the BRICS bloc? Now, they've decided to bring in some new members: Saudi Arabia, Iran, Ethiopia, Egypt, Argentina, and the United Arab Emirates. Now, it seems like they are really trying to shake things up and reshape the current world order that they considered outdated. Now, BRICS is a group of influential developing countries made up of Brazil, Russia, India, China, and South Africa. Now, they are a sort of an informal roundtable conference club which was started back in 2009. Their goal was to challenge the dominance of the United States and its Western allies in the global arena. Right now, South Africa is hosting the 15th BRICS Summit, and expanding the group has been a major topic on their agenda. Now, with these new members on board, the original 6 BRICS nations are expected to have a combined GDP of $27.6 trillion this year. That's around 26.3% of the entire global GDP. And if we include the new members, the number climbs a bit higher to $30.8 trillion, giving them a 29.3% share of the global economy. Now, what's interesting is that BRICS has always been quite a powerhouse when it comes to population. Now, that's mainly because of China and India, who both have 1 billion people. Now, they are bringing in 2 more countries with significant population ratios, which is Ethiopia at 1.6% and Egypt at 1.4% of the world population, taking the BRICS total population contribution to 46% of that of the world. Now, the expansion is a big deal for BRICS. Currently, the group includes China, the second largest economy in the world, along with Brazil, Russia, India, and South Africa. But now, with the addition of Saudi Arabia and the United Arab Emirates, both major players in the oil industry, it's like they're signaling a shift away from the influence of the United States. Now, these countries seem to have ambitions of becoming global heavyweights in their own right. Now, it's worth noting that this expansion is seen by many as a way of the global south to have a stronger voice in international affairs. But it's a bit unclear how much this move will really enhance BRICS' power on the global stage. That will likely depend on how well they can work together and act in unity. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com